Hello, it's Adil bringing you into market analysis perspective on the US markets. Okay, so fundamentals, basically, as we all know, Asian markets higher overnight. I think I've already discussed this in my European market videos. Those of you that are interested and want me to go through it again, it's not a problem. Shanghai higher, Hang Seng higher, Nikkei flat. Okay, potentially negative with the BOJ announcement overnight. The Dow obviously retreats and rallies back up quite substantially, so does the Nasdaq, and so does the S&P 500. And as you already know, if you look at my previous weekend analysis video, you all know that I was calling for a bounce. Okay, right. So obviously we've bounced. Now what? Okay, now what? Let's try and go through the chronological events. Okay, so Asian markets higher overnight. Obviously China and Shanghai is obviously, and the Hang Seng is obviously bullish given this talk of stimulus. So that generally propels commodities higher in theory, and obviously helps risk FX higher in theory, and obviously causes the dollar to fall in theory. Okay. Yes, the dollar did fall, so that's good. US markets have gone higher, that's good. But risk FX hasn't gone up considerably higher except the Kiwi. Okay. And oil obviously hasn't gone high. It's actually broken to new lows given the fact that the news regarding Iran sanctions potentially being lifted and them obviously introducing in excess of 1 million to 2 million barrels of oil per day. So unleashing that amount of supply into the market that's already oversupplied, you know what the laws of supply and demand state. Okay, excess supply, obviously the price will fall, and that's exactly what happened. Now the only concern that I have is that copper, gold and oil are not moving higher considerably, even with this talk of Chinese stimulus. And obviously talk of Chinese stimulus, not only that, of obviously controlling the actual, shall we say, hard landing. Okay, I did explain to you the reason why. One of the reasons why I expect the markets to bounce is because of emerging markets being into support, the Shanghai index obviously breaking out. Now these are all factors, yes, obviously have transpired in the market. Obviously has, as you can see here, daily chart. Shanghai breaking out. So those two factors alone obviously told me that there was a dead cat bounce, or whether it is a dead cat bounce we'll soon find out, because it's all about the dollar. So the move higher today was sustained. Now I nailed it on the Kiwi, I nailed it on the Aussie, on the FTSE and the Euro stocks, but I actually got stopped out on the Nasdaq, folks. I got stopped out on the Nasdaq because when the Nasdaq popped, and given the fact that it was the weakest link, I actually went short around this region here, 4335, coming into the 200 MA. Obviously it's hitting this potential double top pattern here as well, or horizontal resistance, call it what you want. Okay, and looking for a potential reversal down to gap fill eventually. Okay, that obviously wasn't the case with the markets obviously short squeezing and continuing to new highs, and I got stopped out around the 4367 level, because the next level that opens up then is 4410, which is gap fill. I did obviously, I expect that gap fill to close this week, but I did expect that the gap below to close and obviously a potential push higher, and obviously that wasn't the case. Either way, I'm not going to talk about my trading obviously results with regards to this week, but what I will elaborate upon is the fact that oil price hasn't moved higher, and that's not a good sign. Okay, gold prices are still languishing, so that's not a good sign. And copper prices, yes, they did push higher, but there's no considerable move in reality. I mean, 263 to 268, 270, and obviously pushing back down to 267. I mean, that's not exactly bullish. Okay, so obviously not good signs from my perspective. More of a hopium type trade, a short squeeze covering higher rather than actual genuine organic strength. Okay, especially given the fact that the Aussie and the Kiwi still fail to really propel higher. I mean, yes, I know the RBA has its meeting overnight and obviously talk about rate cuts, etc., and that's what's keeping it at bay. But with regards to the Kiwi, I did expect a more of a considerable move there, and that obviously wasn't the case either. So if I bring up the chart, the Aussie, as you can see, it gave up more or less all of the rally overnight. So it's not a good sign. Okay, it's definitely not a good sign. So that's the situation that we find ourselves in. Okay, right. So now what happens? Okay, with regards to the economic data, let's just try and go through that with you. Realistically, nothing really overnight over Asia that was anything really worth noting, or was as important. Other than obviously you had the CHF news flow, again not really going to focus on that. All of the US data today came out negative. and came out weak, much weaker than anticipated. I mean, Empire Manufacturing, industrial production, manufacturing production. So basically, everything came out negative, more or less. I don't think there's anything that actually came out positive today with regards to the US. So strange, given the fact that you had weaker US data and yet the market still propel higher. That only tells you one thing. What that generally tends to tell you is that the markets are focusing on the wording or the word of patience with regards to Miss Yellen. Okay, so she will exercise patience, or she will embrace patience, or multiple reasons. Okay, of her. Number one, the market's already factored in a rate rise in June, and the market's overshot in terms of expectations. Therefore, we're going to pare back expectations. Hence, the reason why individuals are buying into the US markets, because they might have inside information, or they have superior knowledge than me and you, that states that she may well be more dovish than everybody expects. Therefore, you buy the dip. Or alternatively, theory number two is stating that given the fact that everybody's uncertain, the US markets have sold off quite considerably, everybody wants to close their shorts, take profit on the short positions prior to Miss Yellen obviously on the hill tomorrow, just in case she surprises everybody and it creates a massive short squeeze rally and everybody wants to book in and lock in their profits. Okay. Or alternatively, individuals are seeing the dip and seeing that as an opportunity to buy the markets in advance of Miss Yellen. So there's so many reasons. Okay. Or alternatively, individuals are interpreting the divergence between US and Europe as going to an extreme, and therefore they present that as an opportunity to buy the dip. So there's so many different connotations or permutations with regards to the market at this very moment in time. The simple and basic understanding is everybody expects now that Miss Yellen will, and given the talk in the media as well, and obviously some of the headlines that I'm reading, that she will move away patience, or take the word patient out of the equation, but she'll replace that with something else that's also indicating patience, i.e. there will be a 6 month time lag, or a year time lag, or a 2 year time lag before the next rate hike. Okay, or she waters down the original, or she introduces some type of new language. So again, there's, especially with regards to the economic data being weak as of late, and not only that is the fact that every other central bank around the world, especially given the fact that ECB is doing its QE, that in and of itself is actually raising rates, because if the ECB is doing QE, that obviously forces the dollar higher, and that in and of itself is a rate hike, because the dollar is going higher and obviously it's hurting corporate profits, etc. So again, it's debatable. Although having said that, Kathy Leon has cited an article by, I think it was JP Morgan. I was just reading before. This is quite interesting. This, by the way, folks. One of the hot topics in the financial markets and on CNBC today is a question of whether stocks continue to rally with a rising US dollar, and it could not come at a better time with the wrap up of fourth quarter earnings. Okay, in Q4, many big names like P&G, Google, IBM, McDonald's have said a strong dollar stifled earnings, and with the dollar index appreciating more than 10% between January and mid-March, the main concern is that Q1 earnings will take an even bigger hit. Okay, as we all know, for an individual company of sector impact, etc., etc., etc. Okay. In fact, a now well-circulated study by Goldman Sachs found that the S&P 500 is indifferent to FX moves. Since 81, the median annualized return of the index was nearly identical in both strong and weak US dollar cycles, and similarly on a one-year basis. They found the daily correlation of the dollar and stocks to be zero. Interesting, zero correlation. This indicates that many multinational companies do find when the dollar is stronger. Because basically a strong dollar makes raw material imports cheaper and helps to preserve margins. That's the key factor here. Strong dollar makes raw material imports cheaper and helps to preserve margins. Okay, that's the interesting take with regards to that. Anyway, that's the situation. But the counter argument, obviously, she does state that many investors are wondering if the current market environment is different because the Federal Reserve is preparing to raise rates. Borrowing a line from the Brits, stocks won't crash if the Fed opts for a gentle rise in rates. A gentle rise in rates. So again, that's basically what a lot of individuals are obviously are interpreting. Hence the reason why, whether they've got inside information, which I strongly believe that's the case. I mean, the Fed is known to send out emails to VIPs, certain individuals, that they want to front run the markets to keep the markets calm at a time of the presser. Look at the last 15 times the Federal Reserve raised interest rates after keeping them on hold for some time. The S&P rose on average 0.8% 1 month after the first hike. The worst sell-off in 99 when the stocks fell 3.2%, which is a steep but short-lived decline because 12 months later the index was up 6%. As long as US data continues to improve, providing support for current and future earnings expectations, stocks can still rise, which is true. This last stipulation is one the Federal Reserve will need to keep in mind if they want to prevent a crash in equities when they start raising rates. In order to maintain steady earnings expectations, the central bank will need to ensure that rates will not be rising quickly and aggressively, a point we expect Yellen to stress at this week's FOMC meeting. So that's basically why individuals, whether they have inside information, whether they're front running, etc., etc., that explains the stellar move on the S&P 500. Okay, so it's all about the Euro USD. So if the Euro USD continues its slide, that means the dollar is obviously appreciating. That's not good, and that can cause the markets, S&P 500, to fall. As we all know, the Euro USD and the S&P 500 correlation is quite strong now. So keep an eye on the Euro USD. If the Euro USD gives on the 1.05 again, I mean, obviously we've already broken 1.06, and that led to a later sell-off towards the close with regards to the Euro USD, and obviously with regards to the RBA decision overnight, it's going to be very interesting as to what happens with regards to the US dollar index. Okay, right, so that's basically the situation that we find ourselves in. Okay, now let's go to the technicals and let's try and decipher exactly what happened today. Okay, so the S&P 500, let's start from a daily chart perspective. As I explained to you, and as I told you, we were in an inside bar looking for a potential bull flag formation, and obviously that certainly has transpired. Now you are into the first level of resistance here, which is around the 2080 level, and the next level is potentially going to be 2090. Now if you are going to play the concept that you obviously, yes, we are higher highs and higher lows, and we certainly respect that. Obviously we've had the bounce, so I'm going to get rid of that fib. Now at this very moment in time, because this sell-off has been quite substantial, I'm going to take the pivot high and the pivot low, and you are into the 50% to 61% fib resistance level. Now that's a solid resistance zone in the meantime, and that's the one to watch out for. So anywhere between 2080 and 2093, so anywhere in that zone, but 2087 is your fib 61% extension, so that certainly will act as resistance. Now let's go to the 60-minute chart on the S&P 500. Now you have crashed into the, or you've closed the gap, should I say, on the 60-minute chart. The H&S obviously is over now, so let me just get rid of this. We're no longer interested in this. The only thing that we will be interested in is that potential support line, because previous support equals resistance, as we all know in technical analysis, which is quite interesting to observe. Okay, so that diagonal trend line no longer is applicable. Obviously we've broken out of that little cycle now. Okay, so gap level failed to hold. We are into 200 MA resistance at 2082, so that will be your resistance zone for now. Your horizontal resistance obviously will be this level here, so you're looking at 2082 solid resistance, and obviously 200 MA solid resistance, and the gap obviously being closed at 2080. So conclusion here, we're into solid resistance. That's basically my summation with regards to that. Okay, fib, get rid. Obviously we'll potentially be needing that. Get rid, and obviously these levels here, not really interested now. Obviously holding that level, get rid of this for now, obviously leave that for there. Okay, so resistance 200 MA and obviously horizontal resistance, and that's basically where we are. Obviously if we break above that, then you have got 2086 as previous support equals resistance on the S&P 500. Okay, 10-minute chart, obviously we've closed, I mean this is one hell of a stellar rally. I mean look at the 2042 to, I mean it's almost a 40 odd point rally, very impressive. I was just joking during the day. Yellen sent the VP email that she would have remained dovish. Inside information banter anyway. Okay, so okay, there we go. So you've left a gap behind, which is quite interesting, so that certainly leaves the door open to a potential reversal. So remember, all gaps must close eventually, so that's going to be interesting to observe. That gap level hasn't been respected, the market has tore right through it. Okay, horizontal resistance is this zone here. That's basically where we stand at this very juncture. Do I have anything else that I could potentially... Nothing here, nothing here, nothing that I can join, nothing in terms of TA, nothing whatsoever, folks. Okay, so that's basically where we stand on from a technical perspective. Resistance is at 2083. Obviously the gap level was technically going to hold as resistance at 2080. keep an eye out for that. Okay, on the 10-minute chart, certainly looks exhausted, but again, innocent until proven guilty. Okay, now let's cross verify that with the actual. I don't have the Russell updated on here, which is a shame. I can have the Russell updated on here though, so let's go to the Russell IWM. Bear with me. IWM. Where are you? IWM. Okay, 1 second. Let's have a look. IWM. Let's just find out. IWM. Okay, 1 second. Let's just try and work this out. I think I've actually lost the index. Okay, oh, there we are. Okay, found it at last. Okay, so IWM is back at horizontal resistance. Okay, I'm not sure if my daily chart has updated on this occasion. Russell 13th of March. No, unfortunately hasn't updated yet. Okay, so basically it's at the double top resistance. So basically it's not updated. It should have updated by now, but it will come through so slowly. It basically stuck at this resistance level. Okay, that's basically where we are. Okay, I'm just looking at my free stockcharts.com update at the moment. I've got a IG index account as well. I'm looking at the update on there, and basically we're still at a resistance zone. Okay, so no new high on the Russell, therefore S&P 500 is at resistance, and that's basically my take, and hence the reason why I maintain a bearish bias from here. Okay, let's have a look at the Dow now. The Dow Transportation Index I always look at first of all. Okay, so I did highlight to you on the weekend, you're looking at an inverted head and shoulders formation. That's exactly what's transpired, folks. Abracadabra. Okay, that's enough. That's enough applause. Okay, so here we go. So horizontal resistance is in this zone here. Okay, so respect that. So we are coming into horizontal resistance. The Dow transports have started to lead again. So this is something that I did focus on the weekend. Although the Russell hasn't made a new high, so that's a warning sign. Okay, that's a warning sign. That's generally telling you the S&P 500 has had a dead cat bounce. Horizontal resistance on the Dow, transports on the daily chart. Let's have a look. Again, we're coming into diagonal trendline resistance, so it's had its little bounce. Whether or not this holds, if it blasts through, moves to new highs, certainly needs to be respected. Obviously, that will be dependent upon the term and the language from Miss Yellen. Okay, the witch of the West. Okay, so when you're joking. Okay, so Dow transports into resistance. Now let's confirm that and verify that with regards to the Dow daily chart. At the moment, yes, we've had that bounce that I explained that we were going to have, and the market is into horizontal resistance now, so that certainly needs to be respected. And using your fib, taking your pivot high to the pivot low, you are into the 50 to 61% resistance zone. 60-minute chart on the Dow Jones will be more or less similar to the S&P. Yep, we've slapped bang into the 200 MA. We have broken out this bearish channel, which I did explain we will. That's exactly what's transpired for now. Okay, so you are utilizing this resistance level, which coincides with previous support equals resistance, which is just basic TA, folks. Okay, you can go back and see if any key levels correspond. At the moment, not really, and that's basically where we are. Other than that, we're not going any further. You do have one resistance zone here, which has been respected once, twice. Obviously disrespected there. So it's a weak resistance and support zone. But for now, that's basically where we stand. Okay, and market obviously was respecting this level here until we've broken out, and we'll see exactly how it transpires. We certainly are looking for a pullback anyway from the outset with regards to that. Okay, 60-minute chart, 10-minute chart of the actual Dow. The gap fill level exactly was around 11,994 or 17,995. We almost got there at 17,992, so more or less closed, and that obviously will be acting as resistance. If that fails, so that's resistance at 18,030. But the most important thing is we failed to recapture that 18,000 level, which technically, from my perspective, is not exactly a bullish sign. It certainly indicates some warrants, basically, caution. Okay, so we are in this rising contracting wedge pattern and looking for a potential breakdown, so keep an eye out for that. Okay, with regards to the Dow, certainly is into resistance. Now the Nasdaq. Okay, let's have a look at the Nasdaq. Go to a daily chart. Nasdaq itself, yeah, we've had the bounce. Okay, obviously you've got the unfilled gap above, which will act as key resistance if we do get up there. The market has obviously respected this level here. Obviously the gap has closed now. We've had a bounce. Now the key question is whether we can sustain this move or we obviously reverse and do a U-turn. 60 minutes at the moment. Again, very impressive move. You did come up to the 70 region, and obviously you've got the unfilled gap above. We've broken out this bearish expanding wedge pattern, so whether or not we retrace, it's going to be very interesting. If we do, obviously you've got the unfilled gap below. That certainly needs to close. 10-minute chart certainly looks like a stellar move. Okay, your first level of resistance will be 43.76, which is pivot R2, then obviously 44.13. Although you do have an unfilled gap left behind at 43.15, which certainly needs to be one needs to pay attention to. Okay, with regards to the Nasdaq. And let's confirm that with regards to the biotechs. The biotechs, obviously, you can see here made a new high, so very, very impressive, very bullish. Very hard for anybody to certainly be bearish on the biotechs at this very moment in time. Let's just go to a smaller time frame, see if we can get any better clue. Again, higher highs, higher lows. I'm not going to fight that trend for now. Certainly very, very impressive, although I did attempt to fight it last week and that obviously didn't transpire. So anyway, here we go. So we have an unfilled gap below again, so that will act as a magnet, and it's all about the word patience going into tomorrow when the FOMC meeting starts. The actual semicons on the daily chart, let's just have a look here. Daily chart, obviously we do have a bear flag scenario obviously coming into fruition, so again that's something that I'm certainly going to be paying a lot of attention to. And you also have a HNS formation, so this is going to be interesting. As you can see here, right, so we basically have this left shoulder. Okay, so you've got this left shoulder here, you've got the head, you've got the right shoulder, and down you go. Okay, so you've got the pivot high at 100, and you've got the neckline at 95. You're looking at a potential 90 target on the downside. Okay, obviously previous resistance equals support here at 92. Obviously if that fails, then obviously we're potentially going lower to at 90. Okay, so it's a conundrum with regards to the Nasdaq, and it's more about the price of Apple really than anything else. So always obviously cross verify with regards to the movements of the Nasdaq with the chart of Apple, and that generally dictates. And there is an inverted head and shoulders on Apple, so again that's going to be dictated by what? By Miss Yellen. Okay, so for now you have biotechs with a HNS formation. The right shoulder certainly needs to be kept an eye on, out for. So again, this is something that you can't ignore. We are into the 61% fib now, so the biotechs are telling you that the US markets are certain to some serious resistance and expect turbulence. Okay, and that's a summation. Okie dokie then. So we're back to the Nasdaq, and it's all about the gap above, whether that can close. That's dependent upon Yellen and Apple, and we'll see exactly what this market brings tomorrow. It's all about price, pattern, and time. Okay, folks, risk on, risk off, wax on, wax off. Goodbye now.